Hello everyone and welcome to another edition of the Money Pros. I'm Oliver Tutt, Certified Financial Planner Practitioner, and I'll be your host. For the next half hour, we talk about all the issues related to your money, how to make it, how to keep it, and hopefully how to help it grow. Let me give you an idea of what you have in store coming up here on the Money Pros. Interestingly, three actually recent surveys on the costs related to weddings. A little bit of a different spin though. It's not the cost related to what the bride, groom, and parents might bear. It's actually the cost of attending them, which I had no idea was such a big deal, but we're going to talk a little bit about those surveys and what some of those cost implications are. We're joined by my partner and our financial planning pro, Matt Sweet, Certified Financial Planner with Randall Financial Group. We're going to be talking about, we're titling this The Shifting of Risk in the Era of the 401k. A lot of people don't appreciate how much the retirement landscape via employee plans, employer plans has shifted over the past 30 years. So we're going to talk a little bit about that because it's important to be aware of as you manage your own retirement assets. We're going to talk about another piece of information that came out. We talk about a website called Wallet Hub on this show from time to time. I think they do some really interesting research surveys on a variety of different topics. One of the most interesting ones I find is their survey of tax burdens among the states. We're going to talk about what they think are the states with the most and the least overall tax burdens. So they weigh a lot of different factors. So we're going to give that ranking, talk about where Rhode Island, Massachusetts fall in that, the best and the worst, et cetera, et cetera. And then finally, we have a viewer question on an investment product that I will be the first one to tell you I am not a fan of. So we're going to answer that question at the very end of the show. So let's jump right into it. Some surveys that came out recently that talk about the cost of a wedding, and as I alluded to, not the cost of getting married and putting on a wedding, but the idea that there's a significant cost attached with attending weddings. Now, obviously, this is somewhat of a phase of life thing. You know, when you're younger, your friends are in that marrying age, they're getting married, you're more likely to be invited to more weddings. That may tail off for a time period until your kids start getting married and things like that. But some surveys indicate that there's some significant costs with this. So first of all, I'm going to throw up a slide. We'll talk about some of these points one by one. The first one is the average number of weddings that someone attends in a year. Now, this was out of an American Express survey. I got to tell you, I'm going to have to take this with a grain of salt. American Express indicated that on average, people attend 3 weddings per year. I don't think I've attended 3 weddings in the past 20 years. Now, that may be reflective of my limited circle of friends. That would be what some people might say. But I think that number's pretty high. But I tell you what, if you're attending 3 weddings a year, and there certainly might be a stage of your life where that happens, that can get pretty expensive. So next on the slide, the average cost of wedding attendance. Now, the American Express survey indicated that the average cost per wedding for an attendee came in at $703. Now, that's the gift. That is potentially traveling, hotel stays. There could be a myriad of costs that are wrapped up in that. But American Express indicates that their average cost came to $703. Now, millennials, who operate on a whole different program apparently, plan to spend as much as $893, so nearly $900 per wedding they attend. Now, if you're going to 3 of those per year, that's all of a sudden starting to add up to some serious dollars. And according to another survey from another website, bankrate.com, guests in the Northeast, here where we are 2 times as likely to spend $200 or more on a wedding gift. That is an astounding figure. I don't think my parents spent $200 on my wedding gift. Just going to say that. Now, here's the other issue that when it comes to costs is because people recognize that attending weddings are so expensive, there's increasing incidence of people RSVPing that they will not be attending, and their real reason is because it's just too darned expensive. According to Bankrate, 21% indicate declining an invitation due to the cost. Of that, 27% are women and only 16% are men. So I guess men are more willing to spend money to attend a wedding. I find that number a little bit hard to believe, but of course I could be wrong. And finally, a survey from Priceline found that as many as 40%, so this number differs from the Bankrate numbers, as many as 40% of people decline invitations exclusively due to cost. So I think it's safe to say that attending a wedding is probably a significant expense. If you're attending a lot of them per year, it could really add up. At least you can budget ahead of time for that. You get those wedding invitations several months in advance. Start saving your pennies, and hey, if you really can't afford to attend, don't go. I know it's tough, but all right, up next, my partner, financial planning pro Matt Sweet. We're going to be talking about shifting risk of 401ks in the modern era. So stay with us. We'll be right back. Welcome back to the Money Pros. I'm joined now by our guest, Matt Sweet, our financial planning pro, certified financial planner, and my partner at Randall Financial Group. Matt, great to be with you.
Thanks. Good to be here.
This is an interesting topic. We're talking about the implications of the shift from the traditional pension plan, and we're going to talk about what we mean by that, to the more modern, and I say modern, but they've been around for a long time now, 401k plan. And one of the reasons I find this interesting is not really the subject of this conversation because it's applicable to us, but this also coincides with the rise of financial planning. I mean, a lot of the reason that we have careers and financial planning exists is because of this shift from pension plans handled by employers to 401k plans handled by employees. I wonder what you think about that.
Right. No, I agree with you. You're right.
That's what I like to hear. That's a good guess.
I prefer to agree with you whenever possible. Pensions were, while both plans are set up by the employer has much more responsibility about the pension. They basically guarantee a benefit in retirement.
Well, and let's hop right into it. So the first thing we want to talk about, and the traditional pension is really becoming a dinosaur here in the United States, with some fairly limited exceptions. Certainly in most cases, corporate employers are getting away from the pension. But what do we mean when we say a pension? Because a lot of people might think pension, 401k, all the same. What's the difference? What do we mean when we say pension?
Right. In specific terms, a pension is what we in the business call a defined benefit plan. In other words, the benefit is defined, meaning the company guarantees a benefit in retirement. So they say, we will pay you basically a salary almost in retirement for however long that is. So it's not limited by how much it costs.
So employees that have a pension hear terms like, income based on your highest 3 years of salary, how many years of employment you've had. It's kind of qualifying language like that. But ultimately, the employer turns around and says, hey, if you meet these conditions, we're going to send you a check for this amount of money for the rest of your life. And that's really a unique animal. So let's talk a little bit about the pension. When did pension plans first start to come into existence? When did it become the employer's responsibility to take care of people in retirement?
Well, interestingly, you mentioned American Express earlier. American Express was the first company to establish a pension in 1875.
Okay. And
the purpose of them doing it was to maintain a stable workforce. In other words, they were trying to keep people working at the company. So if you have a well-trained workforce and you don't want somebody else to come along and, for instance, pay them a few dollars more an hour, in which case they go work for somebody else, by offering them a pension, it kind of gives them a vested interest in staying at the company for their full career.
So that's fascinating. Investing is one of the terms we use when we talk about whether you're eligible for the pension plan or not. So they started a long time ago, but at some period in the past, and I said recent history, but it's becoming more distant history now, the 401k plan began to supplant the traditional pension plan. When and why did this start to happen?
All right, so 401k plans were initially established in tax law in 1978. So they started coming out after that.
Section 401k of the Internal Revenue Code,
exactly,
right? So it's not, we just didn't come up with 401k.
Yeah, it's a catchy name,
right?
Isn't it? Yes. Precisely. So it gave companies the ability to create a plan like a 401k that we know today.
Okay.
There have been many changes over the years, but the basic structure of the plan was established at that point.
And here's the crux of the remainder of the conversation. What is the difference between a 401k plan and a traditional pension plan?
Well, the employee has significantly more responsibility. They are responsible for funding it themselves. Essentially, that's the key difference. Whereas an employer...
So now I got to start chipping in to that pool of money that formerly was only funded by my employer.
That's right.
Okay.
That's right. So
what other differences?
Oh, there are a number.
Okay.
So we could discuss the investment issue at this point. One of the primary differences is that under a pension, the employer had responsibility for managing the investments of a pension plan.
But before we get to that,
Yeah.
you talked about the pension being a defined benefit plan.
Yeah.
Not exactly the case with a 401k,
No, it's
right?
actually, we call it a defined contribution plan. So the contribution is the key thing. You have to contribute.
And do employers, we talked about the employee having to put away money. If it's just me putting away money, what do I need?
Right.
You know, what do I need the employer
Well, the
for?
employer does match contributions typically. Yeah, most 401k plans have matching contributions.
So there are contributions made by the employer, but all they're doing is guaranteeing the terms of the contribution, not the terms of
what you receive at the end.
the payout.
Right.
So that results in a lot of sort of different ramifications that directly impact employers and employees. Before we get into that, are there situations where the 401k plan would in fact be better for the employee? I'm pretty sure it's better for the employer. We'll talk about that in a little bit. Are there situations where it would be better for the employee?
Well, I would say the reason they were created was that the workforce is becoming more mobile. People were not staying at jobs for 30 years, 35 years like they were in the past. So if you change jobs, a pension is not a good option.
So the whole original intention of American Express to keep a stable long-term workforce, as the demographics of that changed, I mean, from your father's or grandfather's day where they spent their entire career at one company to the time now where you might be at 4, 5, or 6 or 7 different companies, you can't vest and build up as much of a pension benefit. Of course, the 401k is portable, right?
Right, you take it with you.
You can take it from place to
job to
place.
job.
So how have the numbers evolved from pensions to 401ks in terms of participants? What can you tell us about
Well,
that?
I looked up in 1980, 46% of people were covered by a pension plan.
So nearly half of employees.
Right, right, and I believe the rest were not covered by any plan at all, sadly.
Which is a lot of
Yeah,
people in different jobs, sure.
Yep. And then by 2006, the number covered by pension was down to 20%, whereas 43% were covered by a 401k type plan.
So it had really gone like this. I
Yeah,
mean, the
it
401k
shifted.
had taken off, the pension has decreased. That's 2006. I imagine that trend has continued dramatically. So let's talk about a couple of what I'll describe as advantages for the employer, disadvantages for the employee, but it's really about risk shifting risk from the employer to the employee. And the first one is investment risk. What risk did the employer formerly bear that now the employee bears with a 401k plan?
Right, well, they had to fund the account entirely from their own funds. And then they would use the financial markets to invest the funds, but if the markets didn't carry the fund sufficiently, they would have to supplant it with more money. So they bore the risk of the investments in the plan. So if you had a bad year or a bad series of years, the company was on the hook.
So I, as the employer, I make a promise with a traditional pension plan, and if the numbers don't work out because the investments didn't do as well as I thought, I didn't make the right choices, whatever it might be, I'm still on the hook for it's a legal promise. I can't just say, I can't do it short of declaring bankruptcy. I have to put in more of my own money, right?
That's right.
The employer or the employee doesn't have to worry about it at all.
Right.
So with a 401k plan, if there's not enough money there, and we call that an underfunded pension, whose problem is that now with a 401k?
Well, it's the employee's problem. They face retirement, and this is unfortunately a common problem with not enough funds saved.
So we haven't solved the problem of underfunded pensions. We've simply shifted the underfunding from the employer to the employee. The other irony is the people that were handling the 401k plans, the pension plans, the employers, we're talking about CFOs, professional money managers that have the ability to hire consultants and actuaries and things like that to make highly precise calculations of exactly what they need. Does the rank and file of the typical corporation have those same resources?
No, and things have actually gotten better over the years, but usually the employee is left to their own devices. So employers have made some efforts over the years to help employees with their 401ks, but the primary responsibility is with the employee.
And really an epic shift. Let's talk about one other area of risk shifting, and that's the idea of longevity risk.
Yes.
How has what is longevity risk, first of all, and how is that shifted from the employer to the employee with a 401k plan?
Well, bluntly, it's the risk of living too long. And outliving your money. Maybe you put it that,
Right.
put it that way. So, with the pension, the employer was faced with the burden of employees that, had unknown lifespans. Like if your employees lived to be 90, you could have paid them the whole time. Whereas with the 401k, the employee is on the hook for funding that long-term retirement.
And I think probably a lot of our viewers aren't familiar with the idea of the law of large numbers, but as an employer, when you're dealing with a pension and hundreds, if not thousands of participants, longevity risk is significantly diluted because on average, an actuary can determine how long the plan needs to last for each employee. But when you're an individual trying to manage that, law of large numbers no longer applies. It's literally a roll of the dice whether you get hit by a bus the day after you retire or you live to be 110 and you're showing up on the Today Show. So it's a significant amount of risk, and there's not a lot of good ways to manage it on a one-to-one basis. So it sounds like a lot of changes.
There are, and that's a tricky concept to understand, but with the longevity risk, but it's certainly true.
I guess the one good thing about the 401k is you can see your balance building up. Of course, it is portable. We talked about that, but I think the moral to this story is it's become a significant responsibility for employees, and it's one that they have to be aware of and not take lightly because their retirement's at stake.
Yeah. So,
Matt, great conversation. Thank you very much. All right, we're going to have to hold it there. All right, when we come back on the Money Pros, we're going to be talking about tax burdens for the various states. Who's the worst, who's the best, and where does Rhode Island and Massachusetts fall? Stay with us, there's more to come. Welcome back to the Money Pros. Now I want to talk about a survey that came out on Wallet Hub, which is a website I like. They do a good job of surveying various personal finance things of general interest, and they recruit some good experts to really study it in a reasonable way. And one of the things I like is when they rank states based on tax burden. Now, we all know that there's a variety of different tax burdens. The primary ones, and this is what the Wallet Hub survey looked at for 2017, are property taxes, personal income taxes, property taxes being the first category, personal income taxes being the second category, and the third category being excise and sales taxes. And we should all be aware that even if a state is really low in one category, they may in fact be really high in another category. The salient issue is what categories are most appropriate to you. Do you have high income? Do you own a lot of property? Do you purchase a lot of goods and services that may be taxable? Those things. And looking at the overall tax burden, because of course most of us that live in a state, we're subject to all of those taxes. So we need to determine really what's worst on an overall standpoint. So I'm going to throw up a slide. I'm going to talk about some different rankings and where things come in. So this is from, and I say number 3, that's number 3 worst state for overall tax burden, ranking those 3 categories that I talked about. Coming in at number 3 are our neighbors in the Green Mountain State to the north, Vermont, ranked at an overall tax burden of 10.75% of income. And that was primarily courtesy of being the 3rd worst place in the country for property taxes. They were also top 25 worst for the other 2 categories. So generally what you'll see is when a state is really, really bad in the rankings, they are really bad in one category and then pretty bad in some of the other categories. Vermont was top 25 in 2 and number 3 in 1. So that's certainly going to hurt them. Number 2 worst state in the country, Hawaii. Palm trees, oceans, all that great stuff. But if you like taxes, Hawaii is a place to go. That's courtesy of a 1st place worst for sales and excise taxes. Makes Hawaii a tough place to go on vacation because you're not going to pay property taxes or income taxes, but you are going to pay sales and excise taxes, and they're the worst in the country. And the number 1 worst state, no, it's not Rhode Island. Stop thinking that right now. It is New York. New York State, overall tax burden 12.94%. That's courtesy of a top 10 in property taxes, worst, and a 1st place in the worst income taxes in the country. Now, a couple others that I want to touch on. You're going to want to know where Rhode Island ranks. The news is not good. Number 8 worst state in the country, overall tax burden of just a little over 10%. I would point out, though, that's primarily because they're number 5 worst in property taxes. Our property taxes, car taxes, and real estate taxes are horrendous compared to our neighbors and compared to other places in the country. However, our income tax are among the lowest 25. So we're in the better category for income taxes. And if we adjust our sales taxes, we could improve significantly on this list. We're not great for sales taxes. If you live in Massachusetts, they came in number 18 worst, so significantly better than Rhode Island, but they're number 6 in personal income taxes. So if you have a job in Massachusetts, that's a problem, but they have lower sales and excise taxes in Rhode Island. Again, if we lower ours, that's going to be a significant improvement. What are the best states? Delaware, Alaska, and Tennessee, all courtesy of very low or no income taxes and low property taxes. So some things to consider, but not on that list. New Hampshire, Florida, some of the states that people think about a lot when they think about no income taxes because they have higher other taxes to consider. All right, that's a little bit on taxes. All right, up next we're going to answer a viewer question on an investment I hate. Stay with us, there's more to come. Welcome back to the Money Pros viewer question time. We got this one via email, so thank you very much. Person writes in, my advisor is recommending something called a non-traded REIT for a portion of my retirement portfolio. She explained the investment, but I'm still uncertain if these are a good idea. What do you think? Well, I'll tell you what, the first thing I think is if you have an advisor and you still have a question about an investment and you're emailing me, thank you for the email, but you really need to question whether or not you've gotten all the information you still need and if you have the kind of relationship you need with your advisor. Having said that, let me ask your question directly. I hate non-traded REITs. Now, before I get a bunch of hate mail from advisors who use them all the time, am I saying there are situations where they are completely appropriate? No. There certainly could be situations, but in most cases, they're a miserable investment. Here's what you need to be prepared with non-traded REITs, in my opinion. First of all, lack of liquidity. If you put your money into one of these things, be prepared to not be able to get it without substantial penalties for years on end, maybe as much as 5 or 10 years. And it won't be decided by you, it'll be decided by the REIT company who'll decide when to liquidate. And REITs, for those of you that don't know, it's real estate investment trust. So this is a real estate investment. Finally, very high fees. High commissions and high fees to the managers and consultants that run these things. These are not a good investment in my opinion. I would say stay away. Anyway, that's my opinion for today. Thanks for watching The Money Pros. Please watch us again next time, right here next Sunday, here on The Money Pros. Take care, folks.